Welcome to Books in Sum, your go-to for bite-sized book summaries.
The Value of Debt in Building Wealth by Thomas J. Anderson. Thomas J. Anderson's book The Value of Debt in Building Wealth encourages responsible borrowing and is a must-read for anyone who wants to learn how to build wealth without making debt sound shameful. It explains why fortune tellers can't be trusted, how much cash on hand can help you stay afloat in certain situations, and how financial planning is like playing Pac-Man. The takeaway is that debt can be beneficial if handled properly. While 96% of college students polled recently said they'd rather have no debt at all, many Fortune 500 companies still routinely carry debts despite having ample cash on hand. The takeaway is that debt can be useful if handled properly. Taking on debt to fund a purchase and free up cash flow for things like savings is a win-win. Each family borrowed $300,000 at a 3% interest rate, and the Nadas put all of their disposable income toward paying off the loans every month. The Radicals only made the interest payment and invested the rest of their money, earning a modest 6% return. The main takeaway from this blip is to stay away from sketchy debt, save money, and put it to good use. Payday loans and credit card interest rates are two prime examples of debts that can be extremely difficult to repay. Keep low-interest, tax-deductible debts that increase wealth to your advantage. Having access to readily available funds improves your economic mobility. You shouldn't just hoard money. You should also be making long-term investments. Put money away in safe places like savings accounts, 401 seconds, and mutual funds on a regular basis. If you save $15,000 per year, and the interest rate is 6%, you'll have almost $4 million after 30 years. The recommended savings rate is between 15 and 20% of gross income. Checking your wealth can tell you which stage of life you're currently living in. Adding up your assets and subtracting your debts throughout the life phases is the most crucial information in this book. You are in the launch phase of financial independence if your net worth is less than half of your annual income. If your wealth is equal to or greater than 2 times your annual income, you have entered Stage 2, independence. In order to graduate from the launch phase into the independence phase, you must pay off all of your credit card debt, increase your cash on hand by saving, and begin funding a retirement account with the equivalent of 1 month's salary. Adopt a methodical, mathematical approach if you find these objectives daunting. The next step is to build up an emergency fund to cover 3 months of expenses, and a retirement fund equal to 6 months of income. Finally, you should set aside 9 months' worth of income in a third account for major life changes like having children or buying a house. In these later stages, paying off debt and amassing wealth are paramount in order to be financially secure in retirement. The key points of this text are the instructions for achieving financial independence through prudent asset accumulation and reduced debt. This entails maintaining a $200,000 mortgage and a $300,000 net worth. After the third stage is complete, that number should be closer to 35–40%. No divine oracle or skilled fortune teller can accurately predict the future movements of the financial market, so a diversified portfolio is a smart investment for beating debt. If you want to get consistent returns from your portfolio, there are some basic strategies that work better than others. The takeaway is that it's best to combat debt by investing in a diversified portfolio. This is accomplished through a process known as capturing the spread, in which investors profit from their investment's performance over and above the cost of the debt. Investing across a wide range of asset classes, including U.S. stocks, real estate, international bonds, and others, can help achieve this goal. This method is more volatile than closely following the financial markets and business news but still captures the spread 92% of the time. The volatility of individual stocks means that investors can't rely on them to make profitable stock picks. There are typically 3 types of investments in a well-developed portfolio: safe, low-yield investments, more moderate core investments, and high-risk, high-reward investments. While it's true that you should try to stay away from debt and pay it off as soon as you can actually increase your net worth by investing in assets that provide returns higher than your interest rate. Take action. Think about moving into a rental. Many believe that buying a house will set them on the path to financial independence, but renting can also be a good choice. Think about things like taxes, upkeep, and potential loss of value in addition to the mortgage payment when analyzing a purchase. Sometimes it makes more sense to lease rather than buy.
We hope you found this summary helpful in your listening journey. If you're interested in diving deeper into the topic or getting your hands on the whole book, be sure to check the description below where we've included links to the book and other related products that may be useful to you. Don't forget to hit that subscribe button to stay updated on our latest book summaries. And feel free to leave a comment with any suggestions or requests for books you'd like us to cover. Thanks again for tuning in and happy listening.